Hello and welcome to Cindy's Financial Corner. My name is Cindy Couyoumjian. And if you're like many Americans, your investment vehicle may utilize the 60-40 portfolio. This traditional approach to investing allocates 60% of your assets to stocks and 40% to bonds. Although in the past, stocks have produced stable long-term growth, while bonds offer a hedge against the risk of stock market volatility. This strategy may no longer be relevant in today's complex, globally interconnected world. Today, stocks and bonds move together, which negates their purpose. In fact, according to Scott Baker, writing for the National Bureau of Economic Research, no previous pandemic, including the Spanish flu of 1918, has impacted the stock market like COVID-19. Some bond yields are offering close to zero yields. For example, according to CNBC, as of August 10th of 2020, the U.S. 10-year Treasury yield is paying 0.57%. I believe what is needed today is an alternative approach to investing, one that can offer you potentially better returns while managing risk. Although alternative investments have been available to institutional and wealthy investors for several decades, they've only been available broadly to the average retail investor for the past few decades. Alternative investments have become an attractive multi-asset class strategy for university endowments such as Yale, Harvard, and other colleges. David Swanson, who took over Yale's endowment fund in 1985, the endowment portfolio philosophy he used was to allocate a high portion of the total investment into alternative assets, which was largely responsible for Swanson's success over his 35-year tenure as Yale's endowment manager. Today, the individual investor has access to alternative asset classes and structures that large institutional investors have enjoyed for years. The history of alternative investment is a history of mathematical and technological innovation, as well as the response to greed and corruption. The digital revolution, more specifically computing power, has transformed financial markets and made it possible to record, track, move, store, and analyze previously unmanageable and unthinkable amounts of data. Following the 2002 stock market crash, as a result of the tech bubble, alternative investments started to become popular. Given that alternative investments are not intended to be correlated to the stock market, they may offer portfolios broader diversification with a goal of reducing risk. Over time, alternative products became available to the average investor. For example, real estate investment trusts, better known as REITs, are used by many investors, and some of those REITs hold commercial real estate in their portfolios. Some of the benefits of non-traded REITs include diversification, potential hedge against inflation, and potential durable income sources. Other alternative structures that became popular in recent years include business development corporations, or better known as BDCs. Following the global financial meltdown of 2008, banks all tightened their lending standards to middle market businesses. BDCs benefited from this by offering financing to these businesses at attractive rates. In addition, BDCs have established due diligence and underwriting practices that are specifically tailored to middle market lending, which means they understand the marketplace and the industry. The point I want you to understand is this: there are opportunities available to you now that were once exclusive to institutional or wealthy individuals. It's important to note that alternative investments may involve risks that may be greater than those associated with traditional investments and may be offered only to clients who meet specific suitability requirements, including minimum net worth tests. These risks include, but are not limited to, limited or no liquidity, tax considerations, incentive fee structures, speculative investment strategies, and different regulatory and reporting requirements. Keep in mind, there is no assurance that any investment will meet its investment objectives or that substantial losses will be avoided. Diversification does not guarantee profit, nor is it guaranteed to protect your assets. And past performance is no guarantee of future results. Thank you for watching, and give us a call for a free consultation at 714-210-0549.